and turn the program over to Ryan Lockhart, the co-chair of the CCCBA tax section. Ryan?
Thank you, Ann. Hi, everybody. As you know me, I'm Ryan Lockhart, co-president of the tax section. Jay is also here. He's just watching today, but we both thank you all for attending today. This is our first event of the year, and our goal as co-chairs is to have one of these every quarter, and we will be submitting each one of these presentations, including the one today, for specialization credit in taxation. I am pleased to have John Faucher joining us today. He is with Faucher Law, and he is a tax and bankruptcy attorney. He specializes in working with individuals and small business clients to resolve debt and tax problems. He did previously work as a 10-year trial attorney with the IRS, where he appeared both in tax court and bankruptcy court. And he's worked on both the IRS's audit side and its collection side. And he's going to give us some great knowledge today on audits and large tax debts. So John Faucher, thank you very much for joining us, and you can take it away.
Great. Thank you very much. I appreciate it. So yeah, there are two main functions to the IRS. There's collection and there's audit. Audit is they're trying to get to the right number. And this is the auditor who fights with you over what you can deduct and whatnot. And they come finally to the final number. They don't care whether you can pay it or not. They just want to get the final number, the assessment. And then once the assessment is done, your case goes to collections. And collections doesn't care how they got to the number. They just know that there's a number they need to collect. And so we're going to talk about collections today, how to handle a large tax debt. I'm also going to mostly talk about the IRS. Here in California, we're also concerned about the Franchise Tax Board. I'm not going to talk about them so much, but you can just understand that whatever I say about the IRS, the Franchise Tax Board is much more strict, much less lenient than the IRS. The IRS is a big old teddy bear compared to the FTB. You've got, and the basic idea I had when putting this together was you've got a client who owes, say, $400,000 of tax and their life is a mess. And what do? How do they handle it? So I'm going to go through a lot of stuff, and I'm going to go through about 18 PowerPoint slides. Each one of these we could probably do an hour on, so I'm going to go through kind of quickly. The first one, we're going to ask, does the assessment even exist? Is there a way to challenge the amount that they owe? Sometimes the IRS will do an audit and the taxpayer never shows up, and they're going from third-party records, and they assess a huge amount of money that really shouldn't be assessed against this taxpayer. Is there a way to challenge it? Yeah, you can do an audit reconsideration. You can, if they never got the statutory notice that sets forth the assessment, you might be able to challenge it, file a case in tax court, ask what, and to find out whether the statutory notice was even mailed correctly. So, but this is not the point of what I want to talk about. I want to more talk about collection actions. And so basically, I'm going to start out with a fundamental law of gravity. If you've got an asset that can full pay whatever tax liability there is, it's going to be difficult, if not impossible, to avoid liquidating that asset. And so we have Sisyphus here trying to roll up a hill. I mean, what you've got is, you've got a huge tax debt and you've got some asset that can pay it. The IRS is going to want that asset. And so your job is to control and manage how that asset is going to pay that tax debt in general. The asset, of course, includes future income. The IRS has 10 years from the date of the assessment to collect whatever money is owed to it. On the 3,653rd day after the assessment, the entire liability dies. And that's becoming more and more of a strategy for tax collection attorneys, tax resolution attorneys. Can we run out the clock? Can we not pay the IRS for 10 years or pay it just dribs and drabs and let a lot of it die? So the IRS these days is kind of underfunded, undermanned, and this works more often than you might think. How does the IRS figure out what your future income is when it hasn't when it hasn't occurred yet? Well, they basically go on past performance. Past performance is definitely a guide to future results. And so you, as the taxpayer's attorney, your job is to negotiate a peace treaty between the IRS and the taxpayer. And so we've got this lovely picture of policemen arresting somebody. And you have to understand and keep in the back of your mind that when you're dealing with the IRS, you are dealing with the jackboot of the state on the taxpayer's neck. Now, we're often much more, in dealing with the IRS, it's much more polite than that, but this is fundamentally what's going on. It's the taxation power of the state. There's no, the taxpayer doesn't have any choice about whether he owes this tax. He's got a legal duty to pay whatever tax is assessed. And the IRS has tremendous powers. Those powers obviously include liens, levies, and seizures. It's very rare that the IRS actually does what we've got in this picture and arrest people. They do have criminal investigators who can do this, but for the most part, their powers go to ruining you financially. And so what you've got to do is try to figure out some way for you and for your taxpayer and the IRS to live together in harmony and peace. The IRS also considers itself much more of a law enforcement agency than a collection agency. It's very concerned. It would like a relationship with your taxpayer. It wants your taxpayer to be in compliance. It wants your taxpayer to recognize that it's got a tax liability and a tax obligation, and it's going to go ahead and pay that. And to the extent it will do so voluntarily, the IRS loves it. And so that's what you're trying to do, trying to negotiate a peace treaty. I'm not going to be citing very many cases or laws during this session because the law is all on the IRS's side. There are times where people have taken the IRS to court over what it can do in collections, and they generally lose. Your job is to negotiate with some person at the IRS and work out a modus vivendi, a way of being able to go forward in life. So let's go through some of the assets that could be out there. So is the asset money in the bank? Well, this is kind of a no-brainer. Pay it over. There's no reason to try to keep money in the bank when you owe a huge amount to the IRS. You're not going to find an investment that's going to do better for you than paying the IRS, which is always incurring interest and failure to pay penalties, adding up at 0.5% per month. And that's if the IRS would let you do that. If the IRS, the IRS is going to find out you've got money in the bank, and they're going to take it if you don't fork it over. So make it easy. Understand that this is how things are going to go. Now, is the asset money in a foreign bank? Now you got some leverage. I have a client who her mother died in Italy and left her $200,000 in an Italian account. So she's got to report that on FBARs. American citizens and taxpayers have to report all their foreign accounts to the IRS. But the IRS, I actually still have not figured out, can the IRS actually seize that $200,000 in an Italian account? I don't think it really matters. I'm going to disclose it to the IRS. The IRS is going to know where it is. It may be that the Italian tax treaty allows the IRS to go ahead and collect and levy that money. But if it does, it's going to take the IRS a huge amount of time and effort to get it. And so you can use that as some kind of bargaining chip. Yeah, she's got this $200,000. She wants to keep it as much as possible. We have other assets that we're going to try to pay the taxes with, including her future income. And so, if you present something credible to the revenue officer, you're probably going to have that person be allowed to keep some or all of the $200,000 in overseas, as long as she can full pay the tax in a reasonable amount of time. Is the asset a retirement account? So, then think about how old your taxpayer is. Do you have a 40-year-old taxpayer who owes $400,000 and has a $400,000 IRA? Well, the IRS does have the power to put liens and levies on some kind, on a 401k or an IRA. Will they do it? Not likely. It's bad PR for the IRS to start taking retirement accounts, and it's also kind of counterproductive because they don't want to force people to become to go into welfare during their retirement age. But at the same time, they don't want taxpayers to get rich at the expense of the IRS. So your 40-year-old who's got an IRA, who's got a 401k, the IRS can put a lien on that 401k, and that means that the 40-year-old can't withdraw anything from the 401k, but he can't anyway without paying a big penalty, a 10% penalty under IRC Section 72T. So life can go on. The IRS has only 10 years to collect this money. That lien will go away after 10 years. And the 40-year-old will then be 50 years old and still looking forward to 10 more years of productive work life before he can touch the retirement money, which was under a lien, but is now no longer under a lien. One thing the IRS won't do, though, is allow somebody to increase their 401k at a time where the person is not full paying their taxes. So let's see. So I do also just want to go quickly over the difference between a lien and a levy. A lien is, I think of it as a vulture. It sits nearby. It's waiting for something to happen. You've got a notice of federal tax lien that is filed against a house, or it's filed in the county. What that means is you can't sell certain assets without paying the IRS first. But the IRS isn't doing anything. It's just sitting there. The lien is just sitting there, and it's not affecting anybody or anything until a transaction takes place. A levy, of course, is the IRS going into a bank account. It's a hawk swooping down and taking something from the taxpayer. People confuse these two an awful lot. They're very different kind of collection actions, and it's important just to know the difference. All right, let's see. We're going to go to the rare collectibles. So, you've got Pollock paintings on the wall. You've got a Mercedes-Benz gull wing, something worth a huge amount of money, but it's not very liquid. The IRS has liquidation specialists property liquidation specialists who will seize assets like this and sell them at distressed sale prices to help satisfy tax debts. It's not really a great thing to have happen. What you want for your taxpayer is for that asset to be paying down as much of their tax liability as possible. The IRS is going to be selling at fire sale prices. They're not going to be going out and marketing the gull wing the way it should be, getting full value out of it. They would much rather give you time to market this thing correctly, and they'll probably, your revenue officer is probably going to keep tabs with you. What's going on with this asset? How are you marketing it? Where are ads going on for it? What kind of offers are you getting and rejecting for this asset? But the IRS, and they'll give you time. They'll give you a year. A Mercedes gull wing, I'm sure they would give you a year to try to sell that thing. In the meantime, you're probably going to still be paying a monthly installment agreement. Are there several different ways that you can full pay this tax debt? If that's the case, great. Make it easy for the IRS. Propose some kind of plan. Yeah, I've got a gull wing. I'm emotionally attached to it. I don't want to sell it, but I can pay $4,000 a month until this $100,000 tax debt is satisfied. The IRS will be happy to go along with that. as long as they believe that they're going to get full paid in a reasonable amount of time. What's a reasonable amount of time? Probably about 6 years. There are creative ways to do this too. For instance, Willie Nelson famously at some point owed a lot of tax, and the IRS came knocking on his door, and he basically reached an agreement with the IRS where he would go out doing concerts, and at the end of the night, the concert impresario would come to him with a check for, you know, what his proceeds were from the house take. And the IRS guy was right there, and the IRS guy took 30% of that check every night. This was an agreement they reached beforehand. The IRS would have the right to levy on the entire proceeds of that. But, you know, Willie Nelson, knowing that that's what's going on, he would have said, hell no, I'm not going to go out playing on the road again. If I'm not going to be able to see any of this money, there's no incentive for me to go out and play in front of people and then not get paid for it, but just pay my taxes. I'm not doing that. And so the IRS and Willie Nelson reached a deal. I take 70%, you take 30%, and everybody was happy with that. Partly because he was likely to get full paid, or the IRS was likely to get full paid. All right. So, and here's where it starts to get tricky, is the asset home equity. So the IRS, if they see a lot of home equity in a house, they're generally going to ask to see, can you get a home equity line of credit? Can you take out some equity and pay us? And then you've got to ask your client, what do you want to do? Do you want to encumber your house more, or would you rather not? And so there's a few things to think about here. If you have a lot of home equity and you owe a lot of tax, the IRS is very likely eventually to file a notice of federal tax lien. So that tax lien is going to be sitting out there on the house, and you can't touch the equity until 10 years later when the tax lien dies. So is your client going to stay in the house for 10 years? If so, maybe you don't want to get the home equity line of credit, but the IRS is going to still keep pressuring your taxpayer. So what you do is you go out and you talk to 3 lenders and you bring back 3 denial letters, and the taxpayer usually has some control over whether, you know, the lender is going to approve them or not. And so if they can get 3 denials to get a home equity line of credit, the IRS will back off on that request, on that obligation. But if they want to do it, if they think this is a good deal, and sometimes it is, if you get a home equity line of credit on your house, you're often going to be paying lower interest and certainly lower penalties than you would to the IRS, and you can extend that payment over a longer period of time. IRS is going to want to be paid 5 to 6 years. You can get a home equity line of credit for 15 years. So your monthly payment can be a lot lower to your mortgage lender than to the IRS. And you get the added psychological benefit of the IRS is no longer knocking on my door. So that's a good thing to do sometimes, but it all depends on what the taxpayer wants to do. The IRS does have the right to foreclose on a house and take the house. Again, very rare that it does that. They have foreclosed probably, when I was working at the IRS, they were foreclosing on about 500 houses per year. They're really looking for people who are thumbing their nose at the IRS. They're looking for people who owe an awful lot of tax debt. and have owed tax debt for a long time, and they haven't really eaten into it. And that's when they move to foreclose the house. It's not something they want to do. They can. It takes a lot of process. Again, if you can find an easier way for the IRS to collect its money than for your taxpayer to have his house foreclosed by the IRS, do it. And the IRS will give you lots of options to do that. So far we've been talking about the person who can full pay the IRS. What if you can't full pay? We generally have three options for those people. So first is the installment agreement. And again, I've got a picture of some, I think this is the end of World War I, signing the peace treaty there. And again, what you're basically doing is your taxpayer is committing to make some monthly payment. And in return for that, the IRS is agreeing not to do anything else. We're not going to levy on you. We're not going to garnish your wages. We're not going to, they will file a notice of federal tax lien, but they're not going to, they're going to leave you alone. They're going to take your collection file and put it over on the stack where we're not dealing with it. And you just make your monthly payments, and the IRS will, it will leave you alone. How much is the monthly payment? Well, if you can, like I've said before, if you can reasonably full pay in 6 years or so, the IRS is probably not going to ask you very many questions. If you owe $250,000 to the IRS, and you can credibly show them that you can pay $3,500 a month, that would full pay this in 72 months, the IRS is probably going to make some pro forma request of getting financial information, making sure that there's no other asset that you should liquidate before you start making this payment. But they'll easily approve that. If you can't full pay it in 6 years, I mean, well, a few things. If you owe more than $100,000, they're going to ask for some financial information. They're going to ask to see if there's some other asset that you can use to pay this down. When you can prove that there's no other asset, or when the asset is hard to get to, your Mercedes Gullwing, they'll probably leave you alone as long as you can full pay. If you can't full pay either, then they're really going to look at what can you afford? What are your allowable expenses, and what's your income, and what's the difference? And they may or may not ask for 100 cents on the dollar on that difference. But again, here's where you're negotiating. The IRS is going to look at the last 6 months of bank statements. They're going to ask for, all kinds of financial stuff. They're going to ask for receipts from what happens at your house. They're going to ask for utility receipts. They're going to ask for how much are you paying for your car? What are your rental expenses? Or what is your mortgage expense? And they're going to look at this with a fine-tooth comb, and they're going to say you can afford to pay, $1,500 a month, and then you come back and tell the IRS why your taxpayer can't afford $1,500 a month. It's a negotiation back and forth, and at some point the IRS is going to, you're finally going to sign on the dotted line on an installment agreement, form 433D, giving them information for your bank account and saying, here's the monthly agreement that I'm making with you. So this is a good thing. You've got the IRS, agreeing to some installment agreement. You're running out the clock. While the installment agreement is being paid, the 10-year clock is running down, and it may be that your installment agreement doesn't full pay within the 10 years, and that's great. You get to the end of the 10 years, you still owe $100,000. That $100,000 gets wiped out. It's a great result. And then But the best result I like to get for my clients is somebody who really can't pay anything. When the IRS looks at their income and their expenses, and the IRS says, we can't, we can't justifiably take money from this person. We're going to make them uncollectible. That basically there they throw the collection folder on their pile, and they'll come back and take another look at it in 2 to 3 years to see whether something has changed and whether you can pay. If you can, at the end of 2 or 3 years, great. If not, they'll continue you in uncollectible status. And that's basically an installment agreement where your monthly payment is 0. And again, a very good result. The 10-year clock is running during the uncollectible period, and your taxpayer is paying nothing. For the taxpayer, it's a great result. If I can ever get that, I always love it. Let's see. So the next one is bankruptcy. This is bankruptcy is often easier than people imagine who are not in the bankruptcy world. There's a lot of myth out there that you can't discharge taxes in bankruptcy, or that it's very difficult. Not quite the case. If I can get somebody to get rid of a lot of tax through bankruptcy, it's a great thing to do. I'll charge $3,000-4,000 to take them through bankruptcy and get a discharge, and they can get rid of $200,000 of tax. You kind of have to know what you're doing. There are several rules about what is dischargeable and what's not in bankruptcy, and it's very clock driven. It's very cut and dried. The tax return has to be last due more than 3 years before the petition date. The tax return has to have been actually filed more than 2 years before the petition date. The taxes that you're trying to discharge have to have been actually assessed more than 240 days before the petition due date, or the bankruptcy petition date. So it's, and if you make a mistake on this, it's horrible. I mean, if you think that if you mistakenly file a petition a few days early, then you might have $80,000 of tax that could have been discharged 3 days later, but not dischargeable now. So what I always tell practitioners is, if you're talking to a revenue officer at the IRS about your taxpayer, get account transcripts showing what the account transcript shows what the taxpayer owes, what payments have been made, when the tax was actually assessed, and from the account transcript you can figure out when is this tax actually going to be dischargeable. And I also say be upfront with the revenue officer. My taxpayer can't afford to pay you guys. He's going to file bankruptcy in 6 months. If the revenue officer hears that, he's probably going to stop doing anything, because revenue officers don't get bonuses for collecting more tax. They get complimented and recognized by their bosses for closing cases. Having a taxpayer get rid of their tax through bankruptcy is a win-win for the IRS too, because the revenue officer doesn't have to do anything anymore to collect this tax. This is another collection folder that he can just throw on the bone heap. So let's see. And a little snide comment on the chat. So they say, it's in my experience, yeah, the revenue officers, if there's just a few months left before you should be filing bankruptcy, they give up on it. They don't want to try to put any effort into collecting tax when they know this is just going to be discharged anyway. The relevant legal authorities there are 11 USC 507A8 and 11 USC 523A1, where they talk about priority tax and non-dischargeable tax. and what rules you have to meet to be able to discharge taxes. So, okay. So here we've got a question of, can the IRS ask the taxpayer to reduce his or her expenses, renting a cheaper apartment, leasing a cheaper car, in order for the IRS to collect? Yeah, that's a great question. Thank you. The IRS has national standards and local standards for what a person reasonably should be paying to support their lifestyle. And they will definitely go to those local standards to say, hey, we think you should be paying X. And the local standards are kind of ridiculous. I don't know what it is for Contra Costa County, but in Los Angeles and Ventura counties down here, they allow you something like $2,300 a month for rental for a family of 4, which is just ridiculous. There's no way you can touch that. If you've got a local revenue officer, they generally know that. They live in the same area. They know what you can rent for $2,300 a month. And they also know that it's a huge hassle requiring you to move out of your house. And so if they're going to force you to do anything like this, they generally give you 1.5 to 2 years to move out and find someplace cheaper. They can certainly ask these things. And then in terms of, like your food budget or your entertainment budget or things like this, again, it's a negotiation back and forth. The IRS revenue officer will say something like, you're paying $1,000 a month for food. Can't you get that down to $700 a month? And you show the receipts that show, this is what we have to do. And my daughter has celiac disease and needs a special diet or something like this. And you'll be able, and you'll be fine. And again, it's a lot of hands-on negotiating with the IRS revenue officer. They will give you a lot of time to make lifestyle changes if they're requiring that. My experience is usually they don't, unless you're really egregious. I am thinking of one client who is renting a house in Camarillo for $5,500 a month, and the revenue officer never even batted an eye at that. It was her husband, and her daughter, and we were able to get away with a $5,500 rental when the local standard is $2,300, and so they didn't require her to put any more money into the installment agreement because of that. And in general, the revenue officer's incentive is to get this case closed and agreed to, not to squeeze the taxpayer for every penny. And again, I'll mention slightly different at the FTB, different mentality. I think there's 2 things that explain the difference between the IRS and the FTB. The IRS, everybody there knows that they're sitting on the biggest pot of money in the world, and that bringing more money into the treasury is like bringing buckets full of water into the ocean. At the FTB, I think that there are still people there who have been paid in IOUs. They feel an anxiety about getting real dollars into real accounts. And I think there's also something of a mentality of feeling inferior to the IRS. Everybody is afraid of the IRS, but they're not afraid of us. They should be. We wish we were at the big bad mean IRS, so we're going to act like we are what we think the big bad mean IRS should be. So, all right, let's talk about now. Here's in bankruptcy. I mean, I could probably spend another 2 hours talking about bankruptcy alone, but one thing to watch out for if your client owns a house, and we're going to talk about 2 different houses here. The first one has a fair market value of $1 million and a $500,000 mortgage, and the guy owes $400,000 to the IRS. This is a great situation to file a bankruptcy in, because the homestead exemption in California is, is effectively $600,000. That means that if you've got a house that you bring into bankruptcy, that, you're giving the bankruptcy trustee the right to do something with your house. Well, the trustee could sell your house and he could make money on it, except for the fact that whatever proceeds he gets out of the house, he's got to pay you the first $600,000 of those proceeds. And because he can't do that, he's not going to sell this house. He's not allowed to. So you can file bankruptcy with $500,000 of equity in a house and owing hundreds of thousands of dollars, and you get all your debts discharged, including your tax debts, as long as there's not a notice of federal tax lien. The problem arises when you've got a notice of federal tax lien. So we got the same house, but the IRS has finally slapped its notice of federal tax lien on the house. Now what's going to happen is the IRS is going to say, hey, this guy is filing bankruptcy, but he's getting away with not paying any of the tax. But we've got a notice of federal tax lien. So, and that notice effectively means that not only the individual owes tax, but the house also separately owes the tax that it's been liened for, that it's been noticed for. So in that situation, the IRS is probably going to call up the trustee and say, we want you to sell this house. And we're going to reach a deal with you. You're going to sell the house. You're going to get $900,000 for it because it's a distressed sale. You're going to pay off the mortgage at $500,000. You're going to pay us, the IRS, $300,000 out of your $100,000 or your $400,000 notice of federal tax lien. And you, the trustee, get to take $100,000 to pay to all the other unsecured creditors. And this is a deal that they're allowed to make. And the taxpayer debtor has no right to step in the way of this thing. So in that situation, this is a bad idea to file bankruptcy for that house. What I would advise my client to do here is to go ahead and get the home equity line of credit and pay off the IRS. And so this $1 million house, they might be able to get another $200,000 of a HELOC. Great, let's get that $200,000 and get a HELOC, pay down $200,000 of the notice of federal tax lien, of $200,000 of the tax debt, and then let's figure out the next step to do. Well, of course, the problem here is that there's a notice of federal tax lien. What lender wants to be subordinated to a tax lien? Because if they lend money and they just put a deed of trust on here, they're behind the IRS. Well, then you've got to go back to the IRS and ask for a subordination of that lien. The IRS will do that under IRC section 6325. There's a provision for releasing liens and subordinating liens. And if the IRS is getting the proceeds of the HELOC, it will happily subordinate its notice of federal tax lien to the new HELOC going in on the house. So, but yeah, so there is an awful lot to talk about with bankruptcy and notices of federal tax lien, and I can only barely cover the surface of it. Let's go to the next one. Offer and compromise. You've probably heard about these on the radio. We can get rid of 50, 70, 90% of your tax debt. Come talk to us. We can get you, the IRS has a new Fresh Start program. The IRS has a new program there where they're getting rid of tax debt. The problem here is that this is very difficult to get. About 40% of offers in compromise are accepted by the IRS. And the reason is because of the dynamic of this. let's see, pennies on the dollar. Yes, thank you. And so the dynamic here is, we talked about the IRS being the law enforcement agency. We talked about the IRS having the jackboot of the state on the neck of the taxpayer. This is an exercise of state power that there's nothing voluntary about. But when you do an offer in compromise, you are suddenly in a contract with the IRS, and both sides, contract law suddenly applies where it never does in any other dealings with the IRS. And to have a valid contract, if you're going to go back to first year of law school, you have to have consideration on both sides. And so, the IRS certainly is giving up something when it does an offer in compromise. If you owe $500,000 of tax and you're paying it off with a $1,000 check, the IRS is giving up the right to collect $499,000 of tax. That's consideration. What is the taxpayer giving on his side? Well, the taxpayer has a legal obligation to pay $500,000 of tax. So if the taxpayer pays anything to the IRS, it's just satisfying an obligation that already exists. That's not consideration. So the way this works is that the IRS does a very deep financial investigation of the person who's offering the compromise, who's making this offer, to see how much can the IRS reasonably expect to collect in the next 2 years. And they'll come down to a number in the next 2 years with this person working and this person, liquidating all their assets that we, the IRS, have the right to go in and liquidate. We can reasonably expect to collect, let's say $10,000. In order to give consideration to the IRS, the taxpayer has to offer more than that $10,000, has to offer $10,100. And so here's the problem with the dynamics. The IRS is looking at your future income, and you've got to put that on the table today and give it to the IRS in exchange for the IRS writing off the rest of your taxes. And so it's tremendously difficult to do. How do you get your future income on the table today? Hard to do. And how do you figure out what your future income is? If you're a W-2 employee, it's usually pretty easy. I mean, past performance doesn't guarantee future results, but that's, the IRS is generally going to go along with that. If you are an entrepreneur, if you're doing a 1099, if you've got your own shop, if you're a plumber or something like that, it's very difficult for the IRS to figure out how much money you're going to be making over the next 2 years. They don't know that you're not going to become, that you're not going to do some great marketing thing and become the plumber to Silicon Valley and, only dealing with high-end people in Menlo Park who are willing to pay through the nose for your plumbing acumen. So I basically tell my clients, if you have all 4 limbs and you're reasonably healthy and can work full time, you're probably not getting an offer in compromise, because the value of your future income is too high and it's too hard for the IRS to figure out. And whatever number the IRS would agree to is way more than you're ever going to be able to put on the table to settle this tax debt. And except for an offer in compromise, the IRS really doesn't negotiate, doesn't engage in horse trading over the amount of tax that's owed. Again, we've got, I talked about the difference between collections and audit. They work very hard to find the right number of tax that you owe, and then they take very seriously the obligation to collect as much of that tax as is reasonably possible. And they do this because they want everybody to comply with the tax law. I don't want to be standing in my driveway looking at my neighbor and thinking that he might be able to get a sweetheart deal with the IRS that I can't get. So they make this very difficult to get. And in general, you have to be somebody who's never going to work again and have a rich uncle or somebody else like that who is going to pay for you. When I was at IRS, I had one of my jobs was to review offers in compromise for legal sufficiency, make sure that these were binding contracts. And I got to see a lot of very hard luck stories. And one that really stuck with me was a guy who owed $500 million in tax. And he was able to get an offer in compromise. I approved an offer in compromise where he paid $500 for it. What was going on? This guy was a former president of a savings and loan in Texas. He was taken down by the SEC, the FDIC, and the feds. When he submitted this offer, he was 73 years old and residing in a federal prison. And he had a nephew who felt sorry for him and who wrote the $500 check. So this was clearly a guy who was never going, and he had another 10 years on his prison sentence. So he was never going to get out and work again. There was no way that the IRS was going to collect anything from him, and the $500 was a windfall. And so there was a $500 million tax bill that wasn't paid. Too bad. The IRS was happy to write that one off. Okay, so it's rarely granted by the IRS, as we've said. Let's see. Okay, now the IRS is taking some collection action that you don't like. It's filing a lien, it's doing a notice of levy. Let's see. Oops, sorry there. I'll get to this question in a moment, but I see there's a question in the chat and it looks like a big long one, a good one. So IRS, they have a lot of process they have to go through to do some of their collection actions. So a notice of federal tax lien, they can file kind of whenever they want to. It's always a mysterious process to me how and when they decide to do that. It comes out of an office in Oakland, California, for all of us Californians. And it seems to, and I have no idea when they decide to do it. I can be talking with a revenue officer saying, I'm recommending that liens are going to be filed. And I can see that lien being filed either, 1 week or 6 months later. It just seems to be, what is the mood of the guy who woke up that morning and, shows up at his desk, do I file this lien or not? They can, if they want to file, if they want to levy on you, if they want to garnish your wages or take money out of your bank account, they've got to send you about 5 letters in a row, including a final letter sent by certified mail saying, we really mean it this time. We're going to levy on you unless we hear from you in the next 30 days. You've got a 30-day window after you get the certified letter to file a collection due process request. You can file this formal request back to the same office that's threatening to levy. This automatically stops all the IRS collection machinery, and and you've got legal rights to talk to an appeals officer who is basically another revenue officer who has more time and resources to think about your particular case. And you can offer collection alternatives to the levy. And usually that's going to look like an installment agreement, but not always. And the appeals officer is going to look at this and finally determine, yes, the levy is good, or no, the levy isn't. And if you don't agree with the appeals officer says, then he issues a notice of determination. That's another formal letter sent by certified mail. And it says, no, we think that the IRS should levy. And then you've got another 30 days to file a petition in tax court to get in front of a tax court judge to say the IRS shouldn't be levying on me. So it's a huge amount of process that you can get the IRS involved in. It certainly ties them up. The 10-year collection clock stops, and but you've got time to regroup and try to figure out how you're going to pay the IRS. So with that said, let me go back to the chat. And there we go. So since you have some experience at IRS, why does the IRS apply a national standard for personal expenses uniformly across all 50 states? So they, why a national standard when groceries, for instance, might cost more in California than in New York? It's just the bureau, it's just their best way of dealing with the bureaucratic requirement. Basically, we've got to do something. We don't want to spend the time and resources to figure out, to figure out how much people in each different county or each different state should be paying for their groceries. We're just going to issue one number for it. And then they give an awful lot of discretion to the local collection officers. So, that's the best answer I can give you. It's just, it's just part of the landscape when you're dealing with the Internal Revenue Service. If you don't do a collection due process request, sometimes you get a chance to do a collection appeals process or program. Again, you've got a chance to send a letter to the IRS, ask for an appeals officer to look at your case. You don't get the same legal the same legal stuff going on with the collection appeals program. You don't get the same safety net. It doesn't legally stop the IRS collection process from going on, but effectively it does. Usually, people will put a freeze on the account until you can talk to the appeals officer and try to work things out. And if you're doing this in good faith, if you're not spouting, tax protester gibberish, but if you've got a good faith argument for why this collection action shouldn't take place, they'll talk to you. They'll not do the collections, and they offer this for various, there's various collection actions that they will take where they offer this to you. One of the big ones is when they say they're going to terminate your installment agreement. They'll say, we want, you haven't made a payment or something happened, we're terminating your installment agreement. But if you don't think that this is the right thing for us to do, here's a collection appeals program letter, and you can submit this and you can talk to us. And then of course you also have the option of haranguing the manager. You can call, you can ask the revenue officer who is his or her manager and talk to the manager and say, do you know what your collection officer is doing? Can you believe the horrible things that they're doing? You're probably not going to get very far there. Obviously take a very respectful tone. Where I've actually gotten traction is where the collection officer just isn't doing his or her job. If I'm calling the collection officer and I'm not getting calls back, and then I'm getting notices of levy or something like that, that's where I call the collections officer's manager and say, I've been doing my part. I've been talking to the collections officer. I've been trying to talk to him. He's not even returning my phone calls. I'm not disagreeing with his decisions. I'm disagreeing with the fact that I'm having any input into his decisions whatsoever. That can often be very useful. So anyway, at this point, it looks like we're, in time-wise, we're pretty much at the end. The last slide here is me and my feline paralegal, Sebastian. This is, if you go to my website, you'll see that I have I work from my home office, and I have several cats, one of whom is a black and white cat, Sebastian, and we have promoted him into a feline paralegal. He has his own Instagram account, and he's got several amusing cartoons where he talks about tax and bankruptcy law and explains it in a way that I hope is helpful and satisfying to people. And he's even got his own Instagram account. Anyway, if there are any questions, please let me know. I'm always happy to answer questions from practitioners up and down the state. And I thank you for your attention.
Thank you, John, for that informative speech and presentation. Again, anybody have any questions, put them in the chat right now. We have a couple minutes. If not, reach out to John anytime you want. He's graciously offered that to all of us here. I don't see any further questions. So John, thank you very much for joining us today. And Anne, do you have anything to say?
Thank you very much. And next time, maybe we can meet Sebastian in person.
I know.
You know, I asked him to come and help me, and he said no. I mean, I brought him into the office, and he immediately turned around and went scooting the other way, which it's not like him.
Probably had some things to take care of. So.
Probably did, yeah. I do give him too much work. I acknowledge that.
Well, thank you very much, John, and thanks, Ryan. And we'll look forward to the next program coming up in a couple of months.
Great.
Bye-bye.